After an extraordinarily volatile March, one of the most uncertain periods seen in recent years, following the Black Swan event with the announcement of the war against Iran, we're now 1 month later having a closer look on what happened. What were the contagion effects? How has the world reacted? And what have been the implications for Australia in both the short and long term? Stock markets have shown surprising resilience, but with inflation still in play, interest rates under close scrutiny, and global conditions shifting at pace, the outlook is far from clear. What happens next, and what impact could the upcoming federal budget have? That is what we'll be discussing today. Welcome back to Talking Wealth and Bourse TV. I'm Dale Gillham, and today we're joined by a leading commentator in financial markets and the economic clock, Rod North, to break down what's happening in the markets and what to expect. Welcome back, Rod.
Thanks for having me back. And boy, have we had an interesting few months there.
Well, we have had an interesting few months, and I know a lot of people are feeling very uncertain about the market, but we're going to sort all that out today, aren't we?
We certainly are.
Well, anyway, the dominant news in the past 2 months, as we mentioned, has been the unresolved US-Iran conflict, and we've seen lots of experts suggesting the markets would be falling as a consequence, yet both of us in our last recording about a month ago disagreed with the mass consensus, and it seems that apart from the quick fall in March, our assessment was pretty much on the money. Now, Rod, I want you to tell me what your current thoughts are on this, and then I'll give my thoughts in a little bit.
Well, I actually think that we were pretty spot on, because I think a lot of people were concerned that in March we did have a pretty significant drop. And of course, we all know that the share market in particular has been rising since March 2009, where the index was 3,109. It's embedded in my brain. And we were sort of getting over 9,000 in the All Ords and looking pretty good. And then, of course, with the Black Swan event, with the US deciding to take action against Iran, it changed the whole thing. And these type of events can make a massive change to where markets go, as you and I both know. But you've got to have the resolve of, well, is the market over? Have we seen the top of the market or not? Well, both you and I agreed we hadn't. And yes, we did see it fall a bit. I know a lot of people did sell stock.
They did.
And of course, you and I are probably buying in reality off the dip. And of course, what's happened since? We've seen the market pick up and recover, with the Dow, obviously having a bit of volatility, but heading back towards that 50,000, and the All Ords, even today, tipped back over 9,000. And of course, why is that happening? Well, I suppose it's happening that people are realising, well, yes, the whole US-Iran contagion is happening, the war is happening, but we're probably a bit closer to maybe some sort of resolution there, but you really don't know. You wake up every morning, check the news and see, what's happened. And I do remember in the context of history, Chamberlain back in 1938 went and visited Hitler at Munich and came back and said that, peace in our time. Well, like a year later, Czechoslovakia, the rest of Czechoslovakia was invaded, and then Poland a year after that. So basically what it means is that, you can't negotiate with dictators, which is what Churchill said, back in those 30s and 40 period. And it's a bit similar to what we've got at the moment.
Are you talking about Trump or Iran?
Well, I'm talking about Iran. Well, they're both dictators, but we've got a free world dictator and we've got a dictator perhaps, not representing the side of the world that we'd be too happy with, and that creates a real problem. And it's certainly not over. And the big results of that is we've seen the oil shock, we've seen prices go up, we've seen companies and economies and countries fall short, and in particular Australia looking like it didn't have enough reserves, but yet luckily, we've been able to negotiate some deals, with our neighbours in the Asia-Pacific region. Otherwise, we would be in serious trouble.
Well, I think we were lied to there because, as you know, I now live in Geelong.
Yep.
And Geelong has a refinery.
Yes.
Okay, which caught fire. Don't know how that happened.
That was miraculous.
That was miraculous.
Did they get to the bottom of that?
Well, they just said some valve or something, but I think it was a bit of a maintenance thing from there. But obviously, Geelong's not a big place, so people know people that know people.
Yep.
And they have a shed load of supply there. So there was never a supply issue here in Australia, and they were running at 50% production.
Yes.
So I think the issue happened when they tried to ramp up to 100%.
Yes.
But they said, we've got plenty of fuel. And even the fuel price in Geelong is back to where it was before the conflict. So, and to me, it's always a good place to buy fuel in Geelong. It's always cheaper.
Well, that's good to know because it's not too far to get to Geelong now.
Not too far.
Fantastic road there, isn't it?
It is a fantastic road. Well, anyway, soon we're going to look at where markets could be heading over the next few months. But before we do, the federal budget is due out next week. And so let's investigate what's likely to happen. Now, ANZ Research expects the 2026 Australian budget to show an underlying cash deficit that is little change from mid-year economic fiscal outlook. Now, a deficit of Australian $37 billion in 25-26 and a $36 billion in 26-27. Also expects three themes spanning from the short, medium and long terms. Now, in the short term, ANZ Research expects additional temporary costs of living relief for households and businesses to be announced, including a possible extension of the fuel excise reduction. Now, in the medium term, given Australia's reliance on imported refined petroleum products, ANZ Research also expects a focus on energy security, including or via the Future Made in Australia package. An increase in defence spending has already been announced. Now, in the long term, changes to the taxation of investment properties will strengthen the fiscal position over the next decade and provide a path for revenues as a share of GDP to rise. Now, that's a whole lot of stuff, but I want to get your opinion on that, Rod, and what you think is going to occur, because obviously what they talk about and what they put in, we need to make sense of this for everyday Australians. Now, to me, there are three major themes that Australians are really concerned about right now. One is cost of living, or cost of living relief, taxation and energy. So what are your thoughts?
Well, certainly in relation to cost of living, that's a real issue that everyone's facing, because with what's happened in the US and Iran, that's basically forcing the cost of what we're purchasing up substantially because of the supply chain and also the cost of high oil price. And that's been passed on already in the supermarket. So, and then of course this week we've seen the Reserve Bank decide to put rates up again, so 3 times this year. So that sort of equalised perhaps where we were a year ago when they put the rates down.
Yes, well, they had 3 in a row, 3 in a row down, and we had 3 in a row up.
So we're sort of back into neutral territory, but it still creates a concern, for people with mortgages, obviously, because, they're not going to go out and spend. They don't have the discretionary expenditure. And we've already noticed it. We called in yesterday to a cafe and they said, I can't believe there's no one else here, it's just you. And I said, well, maybe that's the effect sort of already playing out. And I think that's the reality, because people have got mortgages, they've got school fees, they've got cost of living issues. So they're big. So, the government's got to look at some packages to help on that side, and that's a real concern. The other big issue, of course, relates to property and how that is going to be taxed going forward. So there's all sorts of shivers going up and down everyone's spine in relation to that, because the federal government made various undertakings when it was to be re-elected that a lot of the areas, particularly in relation to capital gains tax and other property taxes, would remain untouched. But when you're a government with 95 seats in the House of Representatives, you're in a pretty strong position.
And you can do what you like, yeah.
And you can do what you like, and you perhaps have a strong thought that you might get re-elected the next time. So I think that's the thing that's going to impact a lot of people, and particularly if it relates to, taxing even profits in shares, 50% too. It's going to affect the aspirational young people in their 30s and 40s who are trying to build up some sort of nest egg which ultimately might enable them to buy property. So we're in a pretty serious position, I think, in Australia, seeing our inflation rate as the highest in the developed world.
Yes, it is.
And also interest rates moving back up with potential for maybe some more increases, and that creates uncertainty, doesn't it? And I think if you talk to any real estate agents, they'll tell you, gee, things have really slowed down. The demand for property is dropped off substantially. People are waiting and seeing now, but yet the supply is increasing as people are realising maybe they need to offload.
Well, I think you're right there, and I think, you quoted Winston Churchill before, but I think he was the one that said you can't tax your way to prosperity. And that's all that seems to be happening at the moment, is the government is doing taxes, but they keep dipping into the same well.
Well, they spent all their money,
yeah.
So they want ours now.
Yeah.
And they want particularly the baby boomers, because there's a massive, obviously, transference of wealth going to be happening over the next 5 to 10 years. But Those people work very hard. They want to transfer it where they want to transfer it to their families.
So
they want to help their kids with their education, all those sort of things. It's pretty unfair to be taxing it at a high rate and take it away after people have spent decades building up a position.
Do you think the federal government is treating Australians like children?
I do. I think it's because they're mandated to a very high extent, like perhaps no other Labor government has for a long, long time. When you've got a majority, basically you can make the rules and break the promises. And we're starting to see a bit of that happening, and it's not a good look at all. And if you've got a fairly ineffective opposition, with not the numbers and with not the voice perhaps they should be having.
Correct.
It was interesting to see people like Jeff Wilson from Wilson Asset Management come out today and say, well, what's proposed in relation to the taxes for property? It's theft, he's described it. Did you see that?
No, I haven't seen that. I saw Mark Boris this morning on free-to-air TV, and he said, you need to look at the numbers, not the story, because the story the government gives you and the numbers don't match. And this is what Australians are starting to wake up to. It's like, well, yeah, you can say you're doing this and you give me this money, but when they're giving people money, that's just creating worse a problem for the RBA.
Yes.
They shouldn't be doing that. And they're not admitting that the government's the one creating the issue.
And growing the government sector, building the bureaucracy, all of that is substantially driving inflation. And we know that because that's not happening in the rest of the Western world. In economies like the US, the UK and Canada, we've got to look at them and say, well, what are they doing that we're not doing? Well, they're not building a public sector and spending money as if there's no tomorrow like the current Australian government is.
Well, I was reading some research the other day just before we move into, we're going to be talking about the actual Australian stock market in a minute. But I was reading some research last week that was suggesting that the Australian per capita has at least 50% more government employees than the US. And I'm thinking it's conservative. I think it was more like 100%, but at least 30% more than the UK government. So we're the more people working for the government per capita than anywhere else in the world. And it's like, well, how did that actually happen? And that's the reason why because the RBA is saying part of the reason why they're putting rates up is because employment is so high.
Yes.
If unemployment was high, they probably wouldn't be doing it.
Yes.
But we do need to move on. So let's now move on to the stock market. And I'm going to bring up some charts in a minute so we can have a look at that. But do you see more upside or do you see an impending downside coming? And also, which areas do you think investors should be watching right now?
Well, I'm still seeing upside because I think for a market to behave the way it has, with this black swan event holding over it is pretty remarkable. And that's showing that companies are still managing, despite all the other economic turmoil, to improve or grow their earnings. And their sectors, particularly in relation to information technology, AI, mining and resources, and those sort of sectors are still tracking along pretty well. There's been some interesting discoveries. I suppose, even in relation to what's happened with oil, it's making Australia refocus on the fact that we have massive oil supplies in Bass Strait, and we have gas, and we have resource, and we have minerals as well to go back and look at. So I think the share market's still got a fair way to go. Yes. And like any markets, you do see the market have a pullback, but I think the pullback was around 5 or 6%, Dale. You'd probably...
Yeah, it wasn't a lot. I'll have a look at it in a second, but it was a little bit more than that.
Yeah.
Given you mentioned it, how about we go and have a look at the chart anyway? We'll move over to there. So on the screen, you're going to be seeing a chart of the All Ordinaries Index. And I've just kept it really, really simple for the viewers, but because you can see here at the end, this grey line starts after the GFC. And you can see the Australian stock market has really been tracking right around it the whole time, moving up and down and around it. Obviously, that's your COVID low through there, taking off, but still tracking. We just came back in March, basically to that historical trend that we've been on. And obviously, if we're looking at March, looking at that all-time high in February, you can see around about 10%.
Yeah, it's more than you think, isn't it?
Yeah, it's a little bit more than you think, but generally 8 to 15% of a pullback.
But a healthy correction.
Is a healthy pullback, yeah. So obviously we saw April a little bit more bullish, but came right back, and so far this is May. So we know direction is up.
Yes.
It's just what's happening with the market and what's likely to do. And just to show the viewers, and your viewers of Bourse TV may not have seen this.
No, they won't.
This is a seasonality chart of the All Ordinaries Index, and what this is showing the average monthly performance from 1983 to 2026. So what is each month, what's the average performance? And normally April is one of our big months, and obviously July, May and June are generally bearish months. So generally the first part of the year we're more bullish. So we're now into May. So whereas April was bullish, but not super bullish, and obviously March was bearish. So are we going to see a flip where May is more bullish and June's more bullish? Because we know once July hits, we're going to be back in more bullish territory there. But to me, this is really interesting.
Yes.
And a few minutes ago, you talked about some of the major indices. So I actually put them up onto a chart and to see what they're doing this year. And as you can see here, the Australian All Ordinaries Index, we're just in the red at the moment. And obviously you're seeing the Dow Jones up 2.5%, where the S&P 500 is about 5.5%.
Yes.
What's winning obviously is the Nikkei. I clicked the wrong one. Nikkei's up 16% this year, the Nasdaq, which is the tech stocks really.
Yes, a lot of the tech stocks and the big ones, aren't they, that are driving the market
so they've
up.
been driving it, and obviously you can see here the Nifty down in India's down around 8%, and New Zealand's down about 3%. Nothing too bad. But I want to show you the seasonality of the S&P 500 in the US, and this is from 1950. So over the last 76 years, and look at that. June, May, June, July, it's always still bullish. This one here is the Dow, and we're seeing the same thing again. So May is only slightly bullish, and so we generally see this time of year. So I'm not expecting too much for those markets to fall away. In terms of anything big. That's what I'm
like a
looking
20% correction. Or which would be seen as potentially going into bear market territory as opposed to bull market that we're still in, even though it's been from a long period of time. But,
well, that's what I'm saying is the direction. We know the direction is just the uncertainty about what's happening at the moment. So once we get certainty and we start getting oil flowing and everything else, I think there'll be a bit of a lag, but then the money's just going to flow in really hard, I think, to take us to our all-time high. Now, I'm going to show one more thing. If we go and have a quick look back at the charts again, I'm going to show, these are the sectors. Now, you mentioned these just a few minutes ago. This is the yearly sectors, what's going on. So energy's, has gone on a rip terror, and I still think there's lots more in
there.
Energy. So it's done really well. You did mention materials, and it's been holding our market up. It's up 10.86%. Why the market hasn't been super bullish? Financials are only up 4%. And you can see here information technology down nearly 17%, and healthcare.
And real estate too has dropped off quite a bit too.
And real estate's dropped away as well. So,
and healthcare is a big drop.
Yeah, so obviously if rising interest rates benefits financials.
And banks.
We're seeing that. So the banks, I still think materials and energy will do sort of really, really well.
Yes.
But I think we're going to start seeing a move from information technology as well. I still think that. But to me, that's where I'm thinking about areas and sectors. But, obviously the metals for EV and batteries, etc. So they're the lithium is I like that. There's some
Scandium's another one. Scandium, there's a few Scandium.
Silver is also good, because I want to talk to you about, because we've seen gold at record levels and other precious metals rising. Should investors be looking into these areas as well? Because gold has come off an all-time high, come back a bit.
But I see that as perhaps a healthy correction. I don't know whether you agree. Interestingly enough, I've noticed at auction houses, in particular over the weekend, the amount of money paid for silver items, as in silver services and silver, tea and services, because they're being melted down. People are actually
melting them down,
buying it, and gold as well. There was an auction for a gold lion that sold for $15,000, which was basically the gold value, and the purchaser of that's going to melt that gold down. So interestingly enough, a lot of silver items, particularly sterling silver, which is 99%. Interesting, isn't it?
Do they know the quality of gold? Because there's obviously you can melt down gold coins.
That's right.
There's a lot of that in the US.
Yep.
But the actual percentage of gold in it was a lot lower than actual gold bar.
Well, you need to know that, don't they? It's got to be the pure silver, pure gold. But sterling silver has got the 99.9%, I think. They know. But it's like dinner services, because people really aren't using sterling silver to, serve their...
I don't have that kind of finger that sticks out on a cup. But you are right, because obviously silver is much more of an industrial type of metal as well.
That's right.
Because it's got value. I think the it is the most conductive metal they can find.
Yes.
Which is why it's great for batteries, etc.
Yes.
Whole EV and a lot of other industrial applications.
And we're back around, and you'll probably know better than I, the price, we're over around the $50.
It's going up.
And I remember, years back when the bunker hunts drove it up to $50 back in the 80s, and that seemed like a lot, where the oldest,
now, mate.
the Australian, 50-cent coins, the round ones, which were silver,
Yes,
had a face value of 50 cents.
I wish I had a whole heap of those ones.
I've still got a few in the back drawer.
Hard to find those ones anyway. So what's the best piece of advice you can give investors right now?
I think the best piece of advice is to hold your reserve, be cautious, do more research, talk to more people that are experts and get their opinions, because in the context of where we are in cycles, we've still got a way to go. But don't be too complacent to think that we're at the beginning of a bull market when we're not. We're at the end of a bull market, but we believe there's a bull market that's going to run potentially for maybe another 12 months or up to 2 years, potentially. But on that basis, you've got to be a lot more careful.
Yes.
Take some profits where you can, but don't throw the baby out with the bathwater and do what a lot of people did back in March when things turned pear-shaped with the Black Swan event. A lot of people sold, and they're probably regretting that. Don't forget there's a lot of money in super funds sitting in cash, looking to come back into the market.
A lot sitting in cash in my super waiting to get.
And then you look at the charts that you've just been showing too about that weight of money coming back in, showing in the months ahead in 2026 we could see that area rise quite a bit in terms of the share market. But of course, against a backdrop of high inflation and high interest rates, it's a bit of a conundrum, isn't it? Because we've got, not so good things happening on the economic front, but we've got a share market, boom continuing to roll along.
Yeah, I agree with it. I think anybody who's retiring in the next 2 to 4 years need to be very careful with what they're doing in their asset allocation. But, to me, it's don't buy headlines. That's probably the biggest thing that I can give, or the biggest piece of advice I got to say to people, because they're buying headlines at the moment. And you can't buy a headline, you can't buy the stock market. All you can do is buy stocks and sell stocks. That's all you can do. So keep it really, really simple. Don't panic. Don't look at all the headlines, look at your portfolio and look at that longer term picture about where you're heading. But anyway, thanks, Rod North from Bourse TV. You've heard it from the experts here, and this is a co-production with Bourse TV and Talking Wealth. And we're, whilst we are really in an extremely volatile part of the investment cycle at the moment, with lots of moving parts where all investors need to remain highly vigilant and focused, and really that's the message from today. This is your time to keep your head, when often all of those around you can lose theirs. Now, always what we talk about here is seek professional advice from market specialists and experts who can help you navigate through the volatility, and they can also work with you to ensure you're on the best possible, or you're in the best possible position to capitalise on the opportunity, both to increase or even protect your wealth. Thank you for watching.